Welcome to the Commercial Property Podcast. My name is Suzi Carter. I am a chartered surveyor. I've been involved in commercial property in the UK for 30 years and I've done hundreds of commercial property deals. I'm here to be your guide through the commercial property market, whether you're an experienced investor or whether you're literally thinking about dipping your toe in the world of commercial real estate. I will be here talking to you about all kinds of things commercial real estate in the UK, and I've also got some fantastic guest experts who are joining me. So please do subscribe if you'd like to follow, and if you'd like any more help or information on commercial real estate, please do click www.suzicarter.com, which is my website, and you can find out all the ways I can help you. So stay tuned for this week's episode. So welcome back to the Commercial Property Podcast, and it's my great pleasure today to welcome Kallen Brooks from Bond Finance. Now, I'm going to give Kallem an opportunity to introduce himself in a minute, but welcome Kallem, nice to see you.
Hi Suzi, thank you. Thanks for having me on.
Great to see you. And just a little bit of an intro before Kallem introduces himself. So Kallem is a great friend of the Commercial Property Academy. Kallem works with a lot of my clients and does some fantastic stuff with them from a commercial financing perspective. Kallem is a finance broker based in London, and kind of works with a lot of my clients. Also comes along and talks on my board. And you know what I love about working with Kallem, sorry, spare your blushes slightly, Kallem, but what I love about working with Kallem in particular is that he's got the same approach that I have about things, which is he's highly strategic. So rather than just bundling clients off into a certain type of finance, he really spends time to get to know the outcome, starting with the end in mind, and then kind of works that through. So Kallem, would you like to give yourself would you like to do just a little intro before we kind of get going?
Absolutely. So, my name's Kallen Brooks. I work for Bond Finance. Bond Finance has been around since 2004. So we have been through all the stages of 2007, COVID, September 22, and everything that brought. Um, we are mostly strategic partners of a lot of the lenders, but because of that, we are also very specialist brokers. Myself, I specialize in the commercial finance sector. Obviously, commercial finance covers everything, all assets. But obviously, what I also do a lot of is actual commercial assets, mixed use assets, and how the best way to finance them from a strategy perspective, from a structure perspective, and always aligning to exactly what you would like as part of it, and also what you may not have been aware of, that you can actually add in to your strategy for finance.
Yeah, fantastic. Thanks, Kallem. And so talk to us a little bit about where the market has been, because obviously after Liz Truss's disastrous mini budget, which we all know about, then obviously the commercial property market fell, and we've been bumbling along the bottom ever since then. And we kind of have these false dawns, and then Trump comes along, and then budgets come along, and so we're still bubbling on the bottom, which obviously is great news when you're buying because you can buy at low prices, but it has had an impact on finance. Would you just give us a quick overview as to kind of how commercial finance is looking at the moment?
Well, when when there's the market and then there's finance, obviously commercial assets, commercial finance and lenders. So it's quite an emotional dip. It goes up and down very, very quickly, the values and demand in the commercial space. So yes, because of maybe September 22 and that budget, we were been in a situation where the market hasn't been very strong. Obviously, assets hasn't been valued as demand drops, so values drop, and lease lengths or people pull on their break clauses. So all that comes into where the assets kind of are on the floor, as you said. So lenders adapt and they adapt very quickly. And depending on, I know this might be a little bit more detailed, but we have to remember that the lenders also have either using their own money or they're lending others money out. So when it bounces back that second step to knowing who those lenders have lending to them or funding them, it's their appetite as well. And that comes into a broad range. Are they across Europe? Are they funders from America? So you're going to, once you understand that the economics across the funding of each lender and where we are, it's then why we're so low is because they've got so many decisions and there's a lot of decision making before we can say, here's a product for you. This is where the commercial products are. And I know it's you don't see it in the background, but once you understand that what you see from a product perspective has been built over many different decisions of departments, and there's a lot of risk built into it. The reason why the market and the rates are where they are today, do they need to be there? I don't think they need to, but they need to factor in the next 2 to 5 years. That's what the pricing is for. So you can't put a pricing out at 2 or 5 year fixed thinking and looking that the market's not going to change. It doesn't, I don't think it needs to be where it is from a pricing, but they have to factor it in. So the market being one and then understanding where the lenders sit and in their decision making, that's where we get a situation where we think we're at doom and gloom. And it's not completely doom and gloom because commercial investment is in its best opportunity phase in such a long time. And it's understanding why you're in this opportunity phase and where the rates or products or structures can be them in your favor. Um, and so that's where we've been, and we've kind of been sitting. We've been sitting in the same situation. Um, and before lenders' rates change or anything like that, policy changes. And policy allows more people to invest than pricing. So when policy changes, you're able to get someone that wants to go into it for the first time because lenders will lend to them. That builds the market back up because more people are now buying because more people are going into it, so the demand is higher. So yeah, we are in this space now, in a lending position, in a market position, and an opportunity position. And what I'm seeing is policies changing, and policies changing is more comfort to me than anything else. It's showing that there's enough economic data that the lenders are seeing, which is more than I could ever see, more than anyone could ever see, the data they know to predict that something is now moving in a more positive. How long it's going to be positive or how long it's going to take to be very, very positive, no one knows. But when policy changes, it's a very good sign of how the market is now changing.
Yeah, nice. So they basically factor in risk and future risk. And in my experience, having like dealt with resi and commercial, but obviously being commercial specialist, I can see commercial lenders react so much quicker, don't they? Than, they really do react quickly and change their policies and change their rates much quicker. Just because of the nature of commercial property, I guess, tenants and businesses and all that kind of stuff. So, in terms of these policy changes, Callum, kind of what kind of things are you seeing, in terms of, is it kind of that they're valuing on different criteria or, just relaxing, some of the criteria they're lending on?
So definitely criteria, definitely around of in the commercial space, there's obviously three people that are, or three areas. There's yourself wanting and your project, there's valuations, and then there's the lender. So, and all three, I always say I have to get two of you to agree. I can't get you all three to agree. And then where the lender is now adapting and becoming more positive is it would be in the past VP lending, vacant possession lending across everything. That's where they would revert to. Every lender would just revert to that it's like overnight straight VP because it gives them time to then figure out where they want to be sitting from a valuation structure perspective, how they instruct evaluation, how they see these assets. Um, and the word being seen is what I use a lot. It's not that your property isn't the way you see it. It's just that you're asking the lender to see the same thing you are. And that's only time. It's a moment in time that they may not. That doesn't mean it's not real. It's just that they don't see it. So it's always say we have to go to a lender that will see the value. So VP straight away when the market moves so quickly, they straight VP. But where you see policy changes, first time landlords in the commercial space. they will pull over residential experience. So if you own one buy to let, sometimes owning a buy to let can be more, you know, effort than owning a commercial
Yes.
asset. So um, owning a buy to let can be transferable experience for some lenders. Lending off market value, but then deep in the back of like lenders, I'll say we'll go to market value, but up to a percentage of VP. And it's always in the back. It's not a marketing thing, can they? They can't market that to investors. They don't really care. It's up for, brokers and financial professionals to understand those caps. But to me, that's a big thing, lending off market value up to 90% of VP. That's a really good, nice little change because that moves a lot of needles for
Yeah.
certain assets, especially industrial sites or things like that where market value and VP can be similar, but you can push a little bit higher. Um, all those small bits comparing to the asset that you've got are massive. So definitely the experience level of lenders accepting, sometimes first-time landlords and commercial with no resi experience, they will start to accept as well.
Mm.
So all those are changing. And when there's more lenders' policies changing, competition comes back. And obviously, from an investor, you want competition. You want the lenders having a bit of competition, not just a, duopoly of certain lenders that, own that market and they know they own that market. When you've got the high street competing more against each other, and then all the challenger banks are, we've got 7 to 10 commercial lenders now competing. You know, 8 months ago, I probably had three,
Mm.
so competition's there. So that in itself shows how positive the market's moving in that way. Now, again, no one knows what the market's going to be doing, but um, it's a sign to show that it's moving in the right direction. Doesn't have to be snail's pace. It can be snail's pace to me. It can be real as long as it's moving that way. It could move a little bit and then stop again and then move a little bit and stop, which I think could
Mm.
happen. It's a lot of movement, wait to see, movement
Yeah.
again, wait to see. So yeah, it's those policy changes to someone in my field is everything. Is
Yeah.
everything for my clients.
I love that. I love this. So much to unpick from that, actually. So just for the listeners' benefit, obviously vacant possession is when banks instruct valuers to value on vacant possession because they feel edgy about the market and therefore that de-risks them because you're not assuming there's a tenant in there, and obviously market value is assuming there's a tenant paying a rent, etc. And as I said earlier, when you have the market starting to fall, lenders will retract quickly because they're nervous about the risk, aren't they? And what I've found, kind of, this is my third cycle in commercial. What I've found is that there's always a time lag between, it's like that knowledge gap, isn't there, Callum, in between markets recovering and lending starting to relax and, the proper recovery. And so what's really nice about what you've just said, it's one of those kind of early warning signs that we've potentially got. As you say, that could stall, the world's a funny place at the moment, so that could definitely stall. But what's really nice about that is that that's an extra level of knowledge that you've got as a listener, from a listener's perspective, that we're in this sweet spot where prices are still really low and the lowest they've been probably for a decade or so. But you've got lenders starting to, be a bit more open to lending. And so we're in this lovely sweet spot now, so as prices, because prices sometimes rise quite quickly in the commercial space, once they recover, don't they? They recover quickly. So you've kind of, but there's always a time lag between that happening. So yeah, so I mean, it is a great time to invest. I keep telling people this, but it's great to hear it from you as well. It's a great time to invest.
It's so a lot of people might come to me with, I want to get into it. And obviously I say, absolutely, it's a good investment to go into. But then I obviously break down, it's not just going into it. There's a lot of different avenues that commercial assets can have value, and it's all the value you see. And I also connect it to the person. So everyone has their value. my value is probably knowing the finance. So if I, that's what I would bring to, if
Mm,
I did a JV of whatever kind or went into it, I would, make sure my finance. But some value that clients bring to there is just understanding lease extensions and how powerful they are because that's their knowledge base, and that's why their projects are built maybe around their knowledge of leases and break clauses and values of VPs and MVs based on leases. So it's it's a space in which every single person that will do a project might do it differently.
yeah,
Same building, very different projects. And the lovely thing about it is they all can work.
yeah,
That's the beauty about it, is just how and when you can execute it. Obviously, executing it to what you know is easier than trying to adapt an execution model of a different strategy on the same asset, which maybe you're learning along the way. Doesn't mean it's not right. It's just that it might be a bit slower
yeah,
than
yeah.
than than what you would normally know.
Yeah. And you and I work very in a very similar way. So when I start working with clients, we kind of start with the end in mind. Like, what do you want to get out of your investing? What do you want to get out of this asset? And working back from there. And you do exactly the same, don't you? Like, do you want to just give us a little overview? Because I know that you look at like a longer term plan as well for the asset. Do you want to give us a little overview? Like, if somebody comes to you kind of talking about a particular property, commercial property, kind of, how do you approach it with that kind of longer term view?
I the first 90% of the first call or most calls are strategy and structure. What is the strategy for that entire project? And I always discuss it over 2, 5, and 7 years because everyone that comes to me has already done an Excel spreadsheet. They're already done. It's an Excel spreadsheet with all the numbers in it, and it's always it's a term I use. You've heard it before, Susie. Is as soon as they come to me, they put finance in where their feet are, and it's the last thing you should do. It's oh, here's my project. My profit margins are X, Y, and Z for like 5, 10 years. Yet here I am. They look straight at their feet and so what do I have now? And so my first conversations is, okay, what are you looking to do in for right now? What's the asset look like in 2 years? Do the leases change? What does it look like in 5 years' time? What does it look like in 7 years' time? Um, and once I start to break down those conversations, the strategy and structure takes us and molds the finance on the call. It's once it's opened up about what the heart of that project is, the finance, it becomes very the brief becomes a lot more clearer because I ask them, what do you want? And they go, I don't really know. So if the conversation's about strategy and structure, and that's, yeah, right at the end, what does it look like in 7 years' time? What do you want it to look like? And if you want it to look like that, this is the product structure and lending structure you need to make sure at 2 years you get an opportunity to reap the rewards of that rent increase
Mm,
in your favor. So it might be a 2 year model or 2 year fixed rate model to a 5 year. So that's where the 2, 5, and 7 years comes into play in that in any space in the commercial, it's always the fastest way to a 5 year. That's what you want. You get to a 5 year, but that might be a 2 year fix to a 5 year or a bridge to a 5 year, that model. Um, but yeah, the strategy of the project and the structure of the product. And then once you get those two, and then we jumped one more step, and that's the strategy of the valuation
mm,
when determining the strategy and structure of both those things, because the valuation is everything. As we've discussed about VP and market value, lending, and all that, you've got to get a valuer to agree with it. So, yeah, the first stage is just breaking down and asking as many questions around structure of your project. What does it look
yeah.
like? What does it look like? And then work it backwards to where we are today. But adding that column into that spreadsheet of what the finance looks like, because everyone misses that. Everyone puts in what the rate is now or what everything. It's not okay. We're reasoning of a 2, 5, and 7 is I know in 2 years I'm going to restructure because of this actual why I'm going to do it. Because I hear it too many times when someone comes for a refinance. They say, "Oh, the broker just put me in the product." You know,
Yes.
you need to know why you're in it because why you're in it will make sure that you understand if anything was to go wrong. Well, you can't say wrong, but not to plan. The strategy was there. You can't. If your strategy's there. You can't be. It's unfortunate that it didn't work exactly to plan, but strategy and structure will always protect you. It will
Yeah.
always protect you.
This episode is brought to you by Bond Finance Limited, your trusted partner for commercial property mortgage solutions. Are you an experienced residential property investor about to diversify into commercial property, looking for funding options? Bond Finance can help. Whether you're planning to expand, refinance, or make a major property investment, Bond Finance provides expert advice with access to a wide range of lenders, from high street to specialist. Book a free discovery session today to explore how we can tailor commercial funding solutions to your unique investment strategy. Visit www.bondfinanceltd.co.uk and take the next step in your commercial finance journey.
Yeah. I mean, it's so important with commercial, obviously, because you have leases. So leases can be 2, 3, 5, 7, 10 years. And, if you in your finance product, happens to be exactly the same time when there's a break clause or a lease in renewing or whatever, obviously that's got implications. So Callum's absolutely bang on in terms of the fact that you absolutely have to look longer term at commercial. And so, yeah, as you rightly say, Callum, like looking at your feet at a point in time, it tells you something, but it doesn't tell you everything, that's for sure, does it? And there's so many different things you can do with commercial as well. Like I try and make sure my clients have at least 4 or 5 exits on everything they're doing, which again gives you a whole other level of choice. So, like from a financing perspective, to be able to unpick that is obviously really invaluable. So, kind of that's why I refer clients to Callum on genuinely because like rather than just shoving people onto a product, you really kind of try to get under the skin of it, don't you? So that people go on the right product and therefore they know what their strategy is when the finance comes up in 2 years or 3 years or 5 years, which is
Finance is not just for me to know. It's for I want my clients to know. It's not something. It's not IP. It can be. It's with anything. It's the implementation of the finance. Not if you Googled it or ChatGPT it, it'll tell you the answer.
yes.
But it's not exactly that way when you get individuals involved at a valuation and lending perspective. There's definitions of everything, and then there's the way in which humans view that information at very specific times, which is the valuation and the lending underwriting. So, and human and relationships is more important. Not, it's always important in property investing, but in the commercial space, it's very important. Across the agents you might use, agents in the commercial space are normally a little bit more experienced. I don't see many people going first year in selling an industrial site. They've
Mm.
probably been an agent for quite some time. So um, the individuals in those professions have got a few years behind them. So the conversations are a little bit more in depth. So it's good for you to know in depth. And the more questions a client has, the better, because that only digs deep to know why, back to the point, it might be a straight product. It might be, but you understand why. Why is it? Why did we put that in? And it reverts back to there was a strategy there from the start. That's why we went straight into that 5 year. That
Yeah.
and I it's not um I understand that the strategy and structure may be something that it does take time. So it can take an extra few days to really dig in, or a week or two. But digging into the finance and the strategy and structure before you're digging into due diligence is key, because it might save you hours and hours of digging into a project. And then they come to me and they think I'm the worst guy because I tell them it was never going to start. It was never going to be because of these certain points, which is those going to break the deal. So um, it's I promote it a lot, Susie, don't I? And this, that. Just have a chat to someone or a broker or myself pre digging too deep into the DD because there's things I might see or another broker might see that will save you time. And the thing is about you want to review projects as fast as you can, don't you? You don't want to just stick into one too deeply and then opportunity cost and all that kind of thing just kind of catches up on you.
Yeah, for sure. And yeah, I mean the first thing I say to clients is go and talk to Callum. Like literally, like I'll give my view on an asset, but then like you must go and talk to Callum straight away because obviously you understand all the nuances, don't you, of kind of what lender would look at it and why they look at it in a certain way. And I love this because this is why I did an article recently in Property Investor News about kind of the different businesses that AI is going to affect. And on the face of it, AI will affect the brokering lending business, but this is why it won't, because those nuances and that strategy and that structure piece, it just can be AI can't learn that. It's that nuance and that kind of tailoring it to the individual, which is where you add so much value, which is brilliant. Um, so talk to us about, I know you've kind of alluded to it slightly, Callan, but talk to us about who can get commercial finance.
Well, I always say anyone can get it. Anyone. Um, anyone can get commercial finance on commercial assets. That's not a question. It's more about again understanding when the refinance that you're going to get is equal to where you are in the market and the position you are financially at the time. It's only a period of time. So you're I know that gets chucked, the word gets thrown out a lot, but it is true. There is a journey to finance in that your first part of finance that you're going to get on an asset is depicted by your experience level, what you're buying. You know, I know I said, oh, you can bring over buy to let experience, but obviously caveat that you can't then buy a shopping center. So
Yeah.
it's your journey on where you are now and what assets you're buying versus the assets that you can buy in a year's time, the lending that you're going to get. Um, so yeah, anyone can get it, but you got to understand why you're getting that finance. And with that finance, what does it open up for you? Yes, it opens up the next group of lenders that accept experience level. But that necessarily doesn't mean that you're going to take those lenders. You still might use the same lender again. More options doesn't mean you have to take them. More options, you just get more products and strategy to review. You might then fall back to exactly what you like or, the strategy you have about splitting industrial sites or lease extensions or acknowledging uplifted value within a short period of time. If they're those strategies, you might use the same lender for 2 years because that lender sees your asset. It's who sees it in the way that you do. So who's eligible? I can get finance for all assets and borrowers. Obviously, caveat again, financial position has to be reviewed, underwriting. I have to put that in. But no, come to me with an asset with a, you know, acceptable underwriting position from a lending perspective, everyone can get it.
Yeah, perfect. But obviously loan to value and the rates will change
The-
depending on your experience.
They'll go up and down. Some assets will just be seen as what lenders love, so they might be a bit higher in the loan to value still. Um, But the one thing I always try to get clients to be able to understand is even though they're coming from the buy to let space, everyone's used to the buy to let world of stress testing. And a lot of resi assets can stress test okay. Um, but you got to remember the same formula falls across to the commercial space. And when you do rental stress tests, and as an example, rental stress tests are, it's your gross rent divided by anything from 125 to 145%. And then the last part of the formula is the 5-year pay rate. Now, if you're in the residential world and that 5-year pay rate is 5.5%, a lot of things stress test. fine. But in the world where your rates are 6.9, 7.5, 8, rental stress testing will cap your loan to value probably
Mm.
more than what the lender's policy will, you know? So especially when you're buying assets and you don't have the decision that there's a lease in place for X amount of gross rent, you don't get to say anything. And obviously the rental stress tests might only cap you at 60%. So um, it's really good to understand that yes, there's lender's policy, but rental stress tests are a big thing to go work in hand to loan to values.
Yeah.
Because that is the determining factor, is that rental stress test
Yeah.
in the
And
loan to
this
value.
this is where that starting and the end in mind is so important, isn't it, Callum? Because if you understand that, and obviously hopefully everyone should now understand that, now you've said it, if you understand that, I always advocate niching, finding investing locations that work, a strategy that works, then you can bring that into your initial kind of strategy. You don't want to be finding this out when you speak to Callum on a call when you've agreed a deal, and then you're like, oh, I can only get 55% loan to value because of the stress test. You need to be sure that your strategy, is going to kind of withhold that type of test. So this is why multi-lets of industrial, moving from single lets to multi-lets can work because you're kind of doubling the rents a lot of the time, or increasing them quite substantially anyway. Not in every location, this is where the skill is finding those locations where it works. But, and I know we've got a mutual client who is absolutely cleaning up in this space because she spent the time to find out a strategy that works from a structural point of view, but also from a finance point of view, hasn't she? And that's the beauty of it.
Yeah, and the client is digging deep in the parts of not just uplift and value or knowing the difference between market value and VP and how to use them against each other or with each other. Um, but it's that NGDV maxing loan to value because of the rental stress test obviously makes it even better. Because yeah, I do get the odd call going, I've bought this place and with cash and I would like to get out. It says I can get 75% of VP, which technically true. I'm not denying that. But the rental stress test says you cannot.
Yeah,
So, and it's really hard conversation then because it's so hard. In fact, it's a formula. I can't break it. I can't change it. It's there. So, even when clients might come to me and knowing they're going to buy with cash, we still do the same process. I'll still sit with them all day and say, this is what you need to do. I know you're going to buy with cash, and that's absolutely fine, but you need to make sure that you understand that this is the GDVs that you're going to get. This is a stress test. This is how much you're going to leave in because of the stress test or the way in which it will be valued. And then, of course, go and buy with cash because cash is obviously great. It lowers your cost of funds, but it's still helping clients put a strategy in even then. I don't need to put the finance in place there. You know, it 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 works for everyone to understand that even with buy with cash, I can still help you. People can still help you. You don't just have to say, I'm buying with cash, no one's going to tell me until I need finance.
yeah.
Always good to have a call anyway.
Yeah, exactly. And yeah, one of the first things I say to people who I know are buying in cash is, well, buy assuming you're gonna get some finance. So, what I find that does is it lowers the price automatically because when you're feeling punchy with cash and you're not thinking about stress tests, like you know what valuation's like. It's an art, not a science. You can value high, you can value low, you can value in the middle. But when you put that different kind of pair of spectacles on and you're looking at, even okay, I'm buying cash, but I'm going to buy this assuming I'm getting finance, it can kick out a very, very different value.
Right.
So it's so important, isn't it? And so how important is preparing a valuer pack when a valuer is going out, Callum? Kind of what's the relationship between borrowers and valuers in the commercial space?
They are most valuers don't so obviously the transaction speeds of commercial assets aren't as much as buy to let resi. Like
Mm,
they're not going out doing six a day. So the valuation packs that you can prepare for them will be read, will be presented to them. They will read them. Now, do they have to agree with you? No. But there's a very strong correlation between valuation packs and getting a lot closer to what you want or getting what you want than you would ever think that it's the pack itself is prepared for your project. And I say it's not just preparing for the best of the best of the best. It's also acknowledging the weaknesses sometimes of your asset. Because if you get ahead of a slight weakness, they're going to agree with you and not hurt it as much as what you sometimes values can. So it's all bounded on obviously don't make it too long. They're not sitting there for hours scrolling through 15 pages, but making sure they short, sharp, understanding what your project is, what you believe the market value is, what you believe the VPs are, what you believe the market rents are. Data with a pack does a lot for reviewing assets. Comparables, if there is any, that's the hardest thing, making sure there is comparables or find the best comparables you can by, obviously you got a postcode and moving outwards towards until you hit a comparable. And then market rents, obviously, very important for comparables because lenders stress test off market rents mentioned in evaluation, not your passing rents. So you might be a very good landlord, or you might negotiate a very good lease, which is fine, which is great. But if the market rent isn't the same as your passing rent, they stress test the market rent. So it's understanding the two that they don't just your passing rent must be market rent. No, obviously there's an ability of you as a professional that comes into play with your negotiation skills, which is not a lending position of your negotiation skills. So those packs are valuable, so valuable. Yeah, you go to get the odd one which they didn't agree, but they have to acknowledge and write why they don't.
Mm.
So, that is another thing to review. And sometimes you get the reports back and go, okay, he or she had a very good, valid point about why it's not valued the way I want it to be valued. So yeah, valuation packs in even on purchases and refinances, it doesn't harm anything. It's only going to add. Even if it's 1%, 1%, 2%, 3% is a lot on a value.
Yeah,
You know.
absolutely. Perfect. And Callum will sit with you and kind of give you some pointers as to how you need to kind of frame your valuation pack. And obviously, I think it's obvious, but I'll say it anyway. Obviously, the best evidence is from the subject property and from the property itself. So if you buy with cash or a bridge and, can restructure a lease or let a vacant property or whatever, that's always the best evidence, isn't it? So that's where the strategy piece comes in place, I guess.
The An example of that, a little case study, obviously on topic, is a client bought an office, and he could have bought it. It was at auction, so we kind of had to. We could have tried to squeeze a bridge into a term loan because it was, there's tenants there. But he within the leases offered within the pack, he could see there was a rent review in his favour in 4 months' time. So what he was able to do is he called them up and asked if they're going to stay, which you're allowed to do. There's no thing. They have office numbers. You
Yeah.
call them. Um, and obviously they were willing to stay. There is a risk there. They could have said that no one knows that that's going to be true or not. Went in, he won the auction, which is great. But within it, he did a valuation pack and got the valuation written and, you know, written a certain way, which is great because there was a valuation pack. He put all the yields in, all the comparables, and once that was in place, he could then asset manage on the rent review. So we did a bridge, waited for the rent review, the rents went up, and now every piece of data in that valuation about yields was then in his favor. So he went from then doing £900,000 or again figure 800 £900,000 purchase to a 1.3 million pound revaluation within 4 months. Just knowing how and which data with evaluations at points of time are actually in your favor when you know there's rent reviews. And that's two things. That's being able to read a lease and knowing when it's in your favor against the valuation process, against lending policy. So nothing was done wrong. It was all open. Everyone knew it was just a very good structured deal. Albeit he had to sit on a bridge. So the
Mm.
cost of money was cost of money on bridging. But the strategy itself was one of a lovely case study I like to do in all my talks now, which is understanding like a valuation pack, which was the topic I'm talking about now, Suzi, versus a valuation process value versus a lending policy, and they all aligned all at the same time for him. So, um, but also on his note, you got to understand that he was very, very open to sitting on a bridge. You know,
Yeah,
that,
yeah.
sitting on a bridge is a tough request to sit on it and wait when you
Mm.
could get off it, but you had to wait extra to wait for that rent review. And timing is sometimes more important than anything else. So, um, you know, good on him for trying to doing that. But again, that's a valuation pack. Like I said, lender's policy, valuation instruction, all built into the perfect little storm in the client's favor.
Yeah, great deal that one. That's a CPA client. Really,
Mm.
really fantastic deal that one. Took some balls to get that done there
Uh,
initially, but
yeah.
came off in the end for sure. But I think if you're listening to this thinking, gosh, that sounds complicated. Well, the fact is that it's not complicated, but you need to work with the right people to make sure that you understand this because I never pretend that I'm a finance broker. So Kallem and I work very closely together. Kallem comes to talk on the board. I've heard Kallem talk numerous times, but I never pretend that I have the level of knowledge that Kallem has. And so that's why I always refer, clients to Kallem early doors because, he can help with all this kind of stuff. Equally, the knowledge on whether you have a rent review or whatever, obviously, is something that I help clients with. So it's just, I always say with commercial, like it's dangerous investing in commercial without some knowledge. Of course, you can do, but you're going to make schoolboy and schoolgirl mistakes that probably are very, very avoidable. So, working with professionals is always the right thing to do. And then you'll see angles genuinely that, you don't need to convert commercial to resi because you'll see angles in commercial, as I say, some clients have 5, 8 exits on a property that they could pursue just because there's so many different angles sometimes. So, it's really important to do that. So, Callum, thank you so much for coming along today. It's always great to have a chat. And remember that Bond Finance are the sponsor of this podcast, so have been for the last kind of year, and we're obviously really, really grateful for that. But genuinely, I wanted to align myself with kind of a broker who I know it gets results, and Callum always gets results. So kind of again, sparing your blushes slightly, Callum, but kind of, you definitely do. So I would highly recommend anybody listening to this to get in touch with Callum. Just mention this podcast, and Callum will have a chat to you gladly. Well, I'm assuming you will, Callum.
Oh, definitely, definitely. Yeah. It's always that, yeah, give me a text or a call or an email is you can imagine sometimes I'm on the phone, so getting a straight phone call, it's really hard to get back to during the day. But most importantly, Susie, I thank you for allowing me to come on and being a part of your group and um, just allowing me to help people that are really open to being, learning because it is a great space. I love it. I love talking about it and seeing where I can add value. And that's all I want to do. What Bond does is we try and just be value adding brokers. If we want to be able to add value, and sometimes that value is just a bit of phone call to help, and then I might not talk to you again for 6 months or whatever. But I just want to be always seen to be we're adding value wherever we can.
Perfect. Brilliant. Thank you so much. And thank you so much for being on today. Like really always enjoyable having a chat. What we'll do is we'll share the show notes. In the show notes, we'll share all your details. So do look at the show notes if you want to get in touch with Callum and you can do that. So yeah, thank you so much and we'll catch up soon.
Thanks, Susie. I'll speak to you soon.
Yeah, great to see you. Thanks, Callum.